Okay, welcome. Hello. Thank you for those of you attending in person and those attending online via Zoom. And I'm Eric Worley. I'm a professor of finance here, and it's my pleasure to introduce Paul Merriman. He graduated from Western in 1966 and is an award-winning financial educator, author, and nationally recognized expert on investing. And after his talk, I encourage you to check out abundant resources on his website, paulmerriman.com. He has a foundation that has podcasts and videos and anything you want about personal investing. And as a fellow Viking, Paul cares deeply about your future, and we are grateful to have him here to share his insights and advice on creating a successful financial future. Some of you have submitted questions with your registration, and we appreciate those. I would like to point out that those of you that are online currently, that there's a Q&A feature that you can use to submit questions. Please include your email, address, and phone number so that Paul may follow up personally. He's carved out the next couple of weeks to get in touch with folks. And when the time comes, we'll be monitoring questions from both our in-person and online audiences, and we'll do our best to answer those that we can with the time that's left. And of course, Paul will follow up with those that we cannot. And with that, I'm going to hand it over to Paul. Please welcome Paul.
Thank you. Thank you. You noticed 1966, huh? It's a long time ago. Things have changed. You've dressed up a lot since I was here. He did not. Eric, you did not bring up the most important topic of the day. I figured, what could I do that would attract more people to come out and hear this presentation? So figuring that the best way to get people there is to buy their way there, somehow entice them. So out of my own pocket, I took $200 and I bought 100 lotto tickets that will be drawn tomorrow night. Now, this is not a free ride, because here's what happens. If we win, because everybody is in on this, okay? If we win, the first thing that happens, because we might not win the $120 million pot, right? That's possible. That's probable. But we might win something else. All I want to make sure is the first money goes to the financial literacy program here on the campus. $20,000, okay, to them. Then if we win 120 million, we split that. You get half and the school gets half, okay? I get nothing. And I wanted to make it very clear, I did not buy those 100 tickets with foundation money. I bought that with my own money. I know what's right and what's wrong. And so I'm hoping that we'll get lucky. But I also know the odds are very, very small. But in the meantime, I hope that the information that I share with you today will turn out to be very lucky for you in the long term. And we'll talk about luck. That is an important part of the process.
So please, those clipboards are going around.
Do you need to hit something there to get me going? There we go. As mentioned, graduated in 1966, already had my first kid, married at 19. How many of you are married, out of curiosity? A few. Well, at 19, it wasn't easy, but I loved being here on this campus. It was great fun. In fact, I had breakfast this morning with one of my teammates, because I was on an intramural football team called the Keggers. And the reason the Keggers were famous was because we were only scored upon once the entire year. On the other hand, we only scored once the entire year. So, but we did fine with the Kegs. My passion, teaching. I don't care whether you're 12 or 82, I love to show people ways to take advantage of the process of teaching. The good fortune for me is this campus, since since 2012 or 2013 has allowed a course to be taught here, Personal Investing 216, that I could not have gone anywhere else in the country and had them agree to do what we did here. And so I really feel fortunate that that course was accepted, and Dr. Laborde was kind enough to get it going and help build the tradition of. How many people have been through 216 out of curiosity? Oh, okay. Some. Well, I hope more will give it a try. I genuinely want you to succeed. When I showed my wife the slides I was going to use, it didn't say I want you to succeed financially. It said I want to make you rich. And she said, that's not the right attitude. Kids don't want to get rich. They just want to be very successful. Is that fair? How many want to be rich out of curiosity? Yeah, see, it's a small number. How many people are embarrassed to admit you want to be rich? More, okay. So my job is to educate you, and what I want from you is to pass that information on to others. I'm not going to point this young lady out, but there was a young lady who read my book, and she's here. She's a student here now. She wasn't then. And she wrote a really nice review of the book on Amazon. And I know that it helped me get more people to read the book. In fact, I'm going to give you a free copy if you wish to have it. Do we have? Now we don't have enough, do we? Oh, have they? Oh, okay. Because this is also free as a PDF on our website. So if you really liked it, but you don't want to give it away to a friend, you could send the PDF to your friend, okay? All right. 3 ways to make money. I don't want you to waste a lot of time on this, thinking about it, but there really are only 3 ways. If you think about it, there is the work, save, and invest. You can lie, cheat, and steal. And that's where a lot of people get rich, is by lying and cheating and stealing. And then the people, most of us, are going to have to work hard, save, and invest. This one, luck, is really a big deal. Much bigger deal than one would anticipate. Because if you, for example, started investing in 1975, for the next 25 years, the S&P 500, that's the benchmark of the 500 largest public companies in the US, that index compounded at over 17% a year, even though historically it only compounds at about 10. But it was a golden age for investors. Now, having followed the 25-year period like that, it is common sense to think it's going to continue. It's a bias that we have. It's called recency bias. If something's been doing something for a while, we think it's going to continue. And that's a fallacy. Could get you in trouble. But since 2000, that same index has compounded at about 7% a year. So it would have been nicer to start in 1975 than in 2000. It would even be nicer to start in 1973 and 1974, because in 1973 and 74, the market collapsed. And reason that would be nice is because when you are young and you're just getting started in this process, the best thing that could happen to you would be to have the market go down. Why? Because you can buy more what? Shares at a lower price. You don't want to get in at the top of the market. I mean, you do, and I'll show you how you can get in on the top of the market, but you want to make sure that when the market is down, you take advantage of it. So luck, the family you're born into. My parents, by mistake, they forgot that there was a $2,000 life insurance policy that I was to get. So my entire inheritance was $2,000. Now, I have friends who have inherited millions and millions of dollars, and that was out of luck. And I've always looked, and I don't know how you feel about this, but whatever's going to happen likely to you is such a random event, I walked out of a fraternity at the University of Washington, thought about going out to eat. I would love to go out to eat, was thinking about going out to eat, but decided, well, I'll go over to the street dance for a few minutes before I go out to eat. And I went over to the street dance and I met my future wife. And everything is a different history than if I had gone and had dinner someplace. And that's the way our life is going to be. And you're going to go through the same thing. It is virtually impossible to really know what that whole string of events is going to look like. I just hope it's good for you. So luck, it's important. Warren Buffett, to be a success, he said, you only have to do a very few things right as long as you don't do too many things wrong. And when it comes to investing, it is so unbelievably simple as to what the right things are to do. On the other hand, there's this giant industry called Wall Street and the insurance industry. There are a lot of people who want you to do something just a little bit different than what I might think is right. Why is it a little different? Because they've got to get in the middle of you and whatever you're going to do so they can make a profit. And the problem is there are 4 or 5 or 6 people, different kinds of folks who want to take a little of this and a little of that. And pretty soon, instead of you having what you should have, you end up with half of what you should have. I am here to help you get the whole amount, as close to the whole amount as you can possibly get. And I absolutely believe that if you get the whole amount, or as close to the whole amount as you can get, you will retire sooner if you want. You will retire with more money to live on in retirement if that's what you want, or you'll be able to leave a whole bunch of money to Western if that's what you want. And so it is absolutely right. And so often, those things that you do wrong are encouraged by others, whether it's eating food that we shouldn't, but it's what we do because somebody suggested it's cool to do it. Anyway, I believe, and I know this room is good at this, that the key to successful investing is all about the math of investing. And I don't want to talk about specific investments. I want to talk about a situation so you can see the math at work. What we've got here is we've got a starting contribution of $6,000 a year, let's just say for 40 years, and then you retire at 65, and then you are in retirement for 30 years, and you live until you're 95, and during the period of time that you're in retirement, you're taking out 4% a year to live on. In the first scenario, you make 8% a year during the accumulation, and you make 6% a year during the distribution. You invest more conservatively in retirement, and you take more risk during the accumulation period. What that leads to, and this is, I think, how you identify your success as an investment for your lifetime. One is, I know that you invested $240,000. With that 8% return, you'd have $1.678 million at age 65. Your total withdrawals would be $2.6 million. You would have $2.8 million to leave to others. Your real return on your investments was the addition of what you had at the end to leave to others and what you spent, or $5.5 million. Now, that's the math. Now, obviously, the investing doesn't work out that easily that you get 8% a year or whatever. And I'm going to show you how to make a lot more than 8, by the way. But what if we could figure out a way, somehow, whether it's by getting higher returns, by investing in something a little different, or saving expenses, or saving taxes, or something, but you get 8.5 instead of 8. You get 6.5 instead of 6. Now, instead of having 2.8 million at the end of your life, you have 3.7 million. Instead of getting 2.6 million, you have 3.2 million, for a total of almost $7 million. $1.5 million difference because you found an extra 0.5%. Now, if I told you you could pick up an extra half of 1/2% by bending over and picking it up off the ground, you'd say, well, it can't be that easy, but it is that easy. It's just that you have to know that it's there to be done. What if we could even go to 9% instead of 8.5%? What if we could go to 7% instead of 6.5%? You might think at first blush that it would be twice the 1.5, but no, it is more than the 1.5, because now at 3.5 million, that's because you're compounding money on extra money, and so it's going to grow to be a bigger number. So each 0.5% can have a bigger and bigger impact on what you have left over to spend and leave to others. Now let's just add one more thing. Let's say that every year you start out with 6,000, and every year you add 3%. So it's $6,180 the second year, and it keeps growing like that over your 40 years. Instead of putting away 240,000, you put away 452,000. And instead of having $8.9 million over here, where you make the 9 and the 7 and you don't add any money, instead you make another $3.5 million. You end up with 12 million. So now, and I want you to understand, really, this is about your actions, your saving. Oh, saving early. Here, let's look at saving early. If you saved 5 years earlier than the other person, and one person is in there for 35 years and the other one's in there for 40 years, the difference between the two, that 5 years difference of about 6,000 times 5 is $4.66 million. The sooner you can start, and I want to emphasize, nobody's going to do that for you. Now, maybe a parent will, and that's great, because that is a wonderful thing. In fact, somebody even asked the question about what you could do for your kids. Well, one of the things you could do is make sure your kids are able to start early if you have the ability to do that. By the way, that first 5 years is so valuable because you've got time. That may almost give you one extra double when you retire, that extra 5 years. Not quite, but it could be very close. And that one extra double, if I really thought that I could do that, I might even take a second job those first 5 years, just to put that money in there, to have all that extra compounded loot, which could lead to a lifestyle that many people will never get to, because so many people don't even start investing until they're 30 or 35, even 40 years of age. So if there's a partnership in this process, the partnership is between you and the market. That's what the end result is. And the market doesn't care about you. Only you do. The market is going to do what it wants to do. But the return of the market has been so good historically that if you could just get the return of the market and you do your part as the saver, building the business together, because in the early years, you're the one doing the building. It is not the market. You can put in $1,000 and they can go up 10%. You made $100, and at the end of the first year, you got $1,100. You put in $100 profit. What did the market do for me? Almost nothing. But my money's in there now, building the foundation from which you grow these kinds of major bodies of wealth. Mark Twain says, basically, break things. If you got a complex process to go through, break them down into baby steps. And I really think that's important. I think one of the things that's hard for people is if you give them this process all at one time and say, you read there's a great book. I'm not recommending it, but one of the problems of being 80 is you'd be going along and feeling just fine. And then you can't remember something. but I remember the name Daniel Kahneman, and the book is entitled Fast and Slow, Thinking Fast. Isn't that interesting? I could not remember the word thinking. Anyway, I don't get paid for this, so it's not, I won't be docked. Anyway, I really believe that. But it is, oh, that's the cover of the book that you just got. In there are 12 simple ways to supercharge your retirement. 12, and each and every one of the 12 is potentially worth $1 million. Now, particularly for this room. At my age, it would not be worth potentially another $1 million because you need time on your side. But what I do know is that these 12 steps, and I'm going to go through them, are powerful, easy steps. And if you just think about them one at a time, there's not one thing about it that's going to be confusing. I teach it to high school kids and they get it, so I know that it is simple. The first step, $1 million decision, save versus spend. Does anybody have a question why that might be $1 million decision? Right, because there's no way you're going to get the million unless you win the lottery tonight or tomorrow night. And so it's a matter of starting the saving. What we want to know is, where should we save? And in some ways, if I tell you the bottom line, exactly where I'd like you to put your money, you don't need to know about the other things here because they take all those things into consideration. But I do want you to see the kind of the process, the step-by-step process, and the forces that are going to help you. And remember, because some people saving, oh my God, I've got, what is it young people say, YOLO, or you only live once, I got to do it now. Well, saving is spending later. And I can tell you, my wife and I both were good savers, and it made a huge difference later. Yes, we did give up some things earlier, but in the long run, it paid royally to have waited and put money away for the long term. And sometimes it can feel so helpless or hopeless because the market isn't going up, it's going down some of the time. We'll talk about that. Talking about young people, that person who wanted to know what could you do for a young person? If you put away $365 a year, or let's say the first 21 years, and you teach the child to put in $365 a year until they're 65, if you do it from birth until 65 at a 10% compound rate of return, and I'll show you how to make 12, you'd have almost $2 million. If you'd wait until age 10 to start this savings program, it's $755,000. That difference is the difference between another 10 years and those 10 years of $365. It doesn't seem possible, does it? But that's what it is. And if you waited until age 21 to start this program to put away $365 to age 65, it's $262,000. When my last granddaughter was born, my wife and I gave her a check immediately, and it was put into an account that is split between two different mutual funds. I'll talk about those mutual funds in a few minutes. And that money is to fund her Roth IRA for as long as it lasts, when she has earnings to be able to take the money out of the account and put it into the Roth IRA. That's what I would do for a young person, and other than helping them with their education if they need it. This is a huge one, stocks versus bonds. Now, I'm going to guess that 99% of you know the difference between stocks and bonds. but just ever so quickly, stocks represent ownership in a company and an unlimited amount of gain or an unlimited amount of loss. Well, no, not unlimited. They can just go broke and that's it. But there is no guarantee. A bond is a loan. Whether you're loaning it to a corporation or you're loaning it to the government and they pay you interest and then they pay you back what you put into the bond. And here's the reality, and this is so important. This is the biggest decision that you will make above and beyond the saving, and that is stocks versus bonds. There's high risk on a short-term basis, and there's low risk on a short-term basis. Bonds are very, very low risk on a short-term basis. They do almost nothing in terms of going up and down. On the other hand, the stock market, October 19th, 1987, in one day, down 22%. 2000, 2002, 50% during that 3-year period, it declined. In fact, if you were in the technology, if you really wanted to put a pedal to the metal and make a lot of money, put it in technology. Why technology? Because from 1995 to 1999, there were 2 years in a row where mutual funds that owned technology stocks doubled in value. And then they fell 80% from 2000 to 2002. 2007, 2009, another 50% loss. Now, those things sound really scary, and you would not have gone through that with bonds. As a matter of fact, 2008, the stock market was down 39%. Bonds were up 7%. So bonds are great if you want to be in a safe race. On the other hand, when you look at the difference between bonds and stocks, over the long term, the risk is low with stocks, high with bonds. Why? Because bonds don't pay much, and inflation is eating everything alive that you got. Stocks have historically outpaced inflation. So, what do we know? Let's follow the history. Bonds, $100 investment in 1928 in government bonds, short-term, intermediate, long-term. 3 very different kinds of bonds in terms of risk. In fact, you can see the worst year for the short-term bond was almost a break even. For the intermediate-term bond, under 10%, and the long-term bond, 26%. 3 very, very different bond asset classes. Well, what I do notice is the range that $100 grew to $2,000 to $12,000. Now, if you think that looks good, I want you to see the compound rate of return of what $100 grew to in the S&P 500 that I just mentioned, almost $1 million. So for you guys, stocks, that is the place to be as a young person investing for the future. I don't mean the future to make a down payment on a house, not at all. I'm talking about retirement future. And here's what I know. There was a year it was down 43%. I'll talk about these. Well, I'll talk about them right now. These are different kind of companies. Just like there are different kind of bonds, there are different kinds of companies. Some companies are more growth oriented. Some companies are more value oriented. They're less exciting. They don't sell for a high price earnings ratio. People won't pay much for them. But historically, they do in the end make a little more money by 1%. But that takes the 100 to 2.3 million. Smaller, these are big companies. These are big $100 billion companies here. These are $3 billion companies. Small cap blend, some growth, some value, goes to about 4.8 million. If you're in small cap value, the gold ring of asset classes historically. Historically doesn't mean the future. You know that. Nobody knows the future. I don't care how many experts you read who are predicting things and telling you the moves you should make because this is about to happen. No one knows. And it's all, when I say it's a con, I don't mean they're not well-meaning, because it's what they do for a living, is they pretend they know the future. And the problem is you believe them sometimes. And so you make moves thinking that because they said that interest rates were going to do a certain thing or stocks were going to do a certain thing. It was going to make it more likely to be so, which it does not. Nobody has that power. That's why I like stocks. I don't mind the fact that they go down. I'm sorry. Would you step on it, please? Tell her I'll be home tomorrow. Thank you. Here's what I like for you. I want to see the 40-year returns. I am not worried about you for the next year or 5 years or 10 years. I want to know what's the probability of you getting what in the long run if you're willing to put your money into the stock market and let it ride. And I don't mean to make it sound like I'm gambling, but to actually buy and hold for the long term. Every piece of academic research I have seen says that people who buy and hold for the long term come out ahead of the people who are trying to kind of fine tune when to be in and when to be out of the market. It seems so obvious, like when the market fell 22% in one day, we better get out. This could be catastrophic. Feels like a depression coming. That is how it did feel to people. But the market seldom makes it that easy. At least that's my experience of 60 years. But look at this. The S&P 500, the best 40-year period, 12.5. The worst was 8.9. Now that's a big difference. But I will tell you that if you took inflation into consideration, there was a 1% difference in return. So the return on the market after inflation has been very consistent over long periods of time. If you go to the next one here, the small cap, large cap value, 15.6 and 8.8. Small cap blend, 16.7 and 10.6. Small cap value, the best 19 and the worst 11.6. And I would love it if you had 40 years of 19. You'd be well retired. Here's what the market looks like. The red are the bear markets. They are the major hits over the period from 1926 to September 22. And by the way, this is a big hit right here. This was an 80% decline. This was a 50% decline. This was 6 months. Now look at this, is amazing. If you went from about 1950 or so out here to 64, 15 years, well, I mean, it was almost all going up, going up, going up. Now, that doesn't mean it didn't go down on some days or some weeks or some months, but not enough to change the trend by 20% or more. So this is at least looking backwards, the history. Most of the time it is up. And you may think that inflation is bad, and it can be costly in our lives. But as inflation happens, the price of things goes up, profits go up, and funds or stocks or mutual funds that own stocks historically have gone with it. We were talking today about inflation. It may be that for most people, what they have made over their lifetime in terms of additional return or additional income for their work was nothing more than inflation. That they never really got ahead, but inflation kept them going. So, looking again for a second at this large cap value at 13.4, average 40-year return, 13.7, average 40-year for small cap blend, and 16.1, average 40-year for small cap value. Now, why is that number so much higher than the compound rate of return since 1928? Anybody know? I'll tell you what it is. right at the beginning of this is the Depression. So in the early years, every year starting 1928, 29, 30, 31, 32, you are picking up that those numbers are in that 40-year period. Once you get rid of that terrible time of the Depression, the returns look a lot better. That's all it is that most of the periods of time didn't have to deal with huge 80% losses. There was only one period that happened. So you say, and by the way, committing to stocks is the most aggressive thing you're going to do. To say, I want to put my money in the stock market. Now the question is how you put it in. Do you put it in a way that you are likely going to win in the long term? Do you do it in a way that the probabilities of success are in your favor? Or are you going to go into the stock market in a way that the probabilities of success are very iffy? And I'll show you why. Here's what we know about one stock. You can lose it all. When I was your age, there were a number of companies, and I had a desire to go into the brokerage industry. So when I was your age, I was aware of this and interested in this, and have been ever since. But when I was your age, there were a few companies that were known for kind of an automatic step. You may not like the job, but you could go to work for Sears Roebuck as a janitor and end up being a millionaire in retirement. How? Because you were a janitor at Sears, and as a janitor at Sears, you would get Sears stock. And all you needed to become a millionaire was to own Sears stock. Well, that's the way it had been in the past. And people just assumed that it's going to continue. At that same time, there was a saying, as goes General Motors, so goes the United States. General Motors was in essence, the canary in the coal mine, because if General Motors is having troubles, look out. Well, what happened to General Motors? What happened to Sears? What happened to GE? What happened to Washington Mutual? They didn't make it, or they didn't make it as big as people thought they were going to make it. The fact is, and when I say the fact, looking backwards, Dr. Bessenbinder did a study, and I'm going to give you information on that study in a second. Of all the stocks that were around over the period from 28 or 26 and on, 3%, 96% of the companies compounded at an average rate of 3%. This is the market that makes 10%. So everybody thinks that must be, what it could probably be in a whole bunch of different stocks and make 10%. Well, you probably could, but at least over this whole period, only 4% of the stocks made up the difference between that 3% and the 10%, a handful of companies. And here's what the academics tell us. And I'm just going to tell you, if the choice is between Wall Street, the academics, or your neighbor, okay, I would go with the academic community. They're the only ones that look at it long and hard and face the bad times as well as the good. Wall Street tends to focus on the good, not the bad. But you see, if you owned them all, you would have gotten the 10. If you tried to cherry pick your favorite 3 or 15, in fact, when I came into the industry, we were taught, and I was a stockbroker for about 2 years, we were taught that all an investor needs is about 10 to 15 stocks. That's all the diversification you need. Well, today, the academic community tells us in every different equity asset class you might go into, remember, we had big stocks, we had small stocks, we had value, we had growth. Each one of those, we should have at least 100 companies. And so if you own them all, you're in essence guaranteed to get that market return. What we don't know is what that market return will be. But we also don't know what the price of cryptocurrency will be. We don't know We don't know anything for sure, but there is a low risk way to get historically a very good return, and that is to own them all. And here's the study by Dr. Bessenbinder. By the way, there's a PDF of this that you can pick up. I don't, where do they get it?
SSR.
No, I mean the PDF of this.
Your book.
And of this whole presentation. Oh, you'll make that. Okay, that's great. Okay. Mutual funds. Now, honestly, how many people don't know what a mutual fund is? Be honest, because then I'll know how much time to spend on it. Okay, mutual funds. Mutual fund is an accumulation of investments from a whole bunch of people. Literally, could be millions of people. And it goes under the management of, let's say, a team of people, of very smart people. Their desire could be to beat the market. Their desire could be to be the market and look like the market. You can get both, and we'll talk about them. But that mutual fund, and I'll talk a little bit more about it later, but that mutual fund is built so that each and every one of us in this room, if we had $100, could put that into a mutual fund and have it managed as if you had $1 million. They are an amazing product. But there are over 10,000 of them, and they're very different. Some of them are very different in that they represent things that are more risky than I wouldn't want you to be in. Some of them are very different because they have very little diversification. Others have a lot. Some of them are different because some are expensive to run and some are cheap to run. The key is to figure out which of these kinds are in your best interest. But it is really, and by the way, you can get bond mutual funds, you can get stock mutual funds, you can get cryptocurrency mutual funds. You can get mutual funds that have high expenses, you can get mutual funds that have low expenses. And if I tell you that I know where there are mutual funds that the expense is, let's say, 0.03% a year to manage the money, or I told you about another fund that cost 0.85%. Which one would be theoretically the lower cost fund? Well, obviously the one that's 0.03%. But it's your choice. You can buy the expensive ones. They're for sale. You can buy mutual funds that have a commission to get in them. When I was your age, the commissions were 8.5%. You put $1,000 into one of those mutual funds, and immediately $85 was gone forever to grow in somebody else's family's pocket, okay? Today, most people buy no-load funds where there's no commission to buy. And you may think today it's like a 5% commission. But a 5% commission on an equity fund, a stock fund, it's going to cost you 0.5% a year for the rest of your life in returns. And I'm looking for 0.5%. You're looking for 0.5%. One way to get 0.5% is to be in a mutual fund that has low expenses. Fidelity actually has mutual funds with 0 expenses. Here's another place that 0.5% pops up. There are mutual funds that are actively managed. Why are they actively managed? What is active management? Buying and selling inside of the fund. Then there are people who run these index funds I mentioned. They put the money in these companies and they basically just leave them there. Now there's more to it than that, but it's basically what they do. They don't trade. They don't switch around. They're not looking to be in the best companies. They want to be in all the companies. Remember, we're going back to the high likelihood that you're going to get the 10% if you own all of the companies? What we know is those so-called actively managed funds, their returns can be as low as 2 to 3% less per year for 20 years. Now remember, I was worried about you being cheated out of 0.5%. Well, how could that be? Well, because they picked the wrong stocks. They traded at the wrong time. And they were paid big bucks to do it. Whereas in the index fund, the passively managed fund, none of that was going on. And because you hired a manager to be in the right companies at the right time, even if they didn't do it for you, they didn't know they were going to do it until after they didn't do it. In the meantime, they've been paid higher fees in the hope that they're going to beat the markets. But here's the fact. There's a study updated every 6 months. It looks at all of the actively managed funds versus the benchmarks, the indexes. And about 1 out of 10 over a long period of time, 20 years, let's say, about 1 out of 10 is able to be better than the index. And nobody knows how to pick the 1 out of 10. If we knew how to pick the 1 out of 10, everybody would want to buy that fund, of course. But nobody knows how to know what it is ahead of time. And we are talking about 20 years. I mean, does anybody even know what kind of country this is going to be 20 years from now? You don't. So it's the same with investing. We don't. And oh yeah, lower taxes. Index funds, passively managed funds, pick up about a 1% extra return by charging. Now, by the way, this is for people who are in a high tax bracket. So it would be a lower if you were in a lower tax bracket, but it's about a 1% difference in return after taxes. Because the one thing is, of course, if you got your money in a Roth IRA or a 401k, you're not worrying about taxes. But later, when you've saved a lot of money and you've got extra money to put in a taxable account, you don't want to have to pay more taxes. And that's an index fund as a choice for lower taxes. So going back to these asset classes, just like you can put your money in a money market fund. Money market fund guarantees more or less a particular rate of return, and you can cash out for $1. If for dollar you put in, you cash it out plus some interest on the money while you were in there. But that's different from a T-bill, which will pay a little more but have a little volatility. That's different from an intermediate bond, which will pay a little more and have more volatility. And that's different from a long-term bond, which will pay a little more and have even more volatility. And that's different from a high-yield bond. And I mean, there's all these different kinds of bonds. Well, it's the same thing with stocks. There are big stocks, there are small stocks, there are growth stocks, there are value stocks. They pay different rates of return historically. And the question is, does it make any sense to put all your money in this one kind of fund? Well, I will tell you that there are a whole lot of people that's all they do right there. They'll put that money in the S&P 500 or the total market index, which is a similar kind of fund, but has virtually the same return and risk since 1928. So, the question comes for you, should you have all your money in the S&P 500 or should you have it in these different equity asset classes? Now, at some point, you may decide to go to our website and dig into what we call boot camp. You really, I mean, it gets deeper. It's not complicated, but there are more numbers to look at and to understand. Because what we do there in boot camp is we show you the implications of combining this with this and all 4 of them, well, like right here, here's all 4 of them right there. The combination made 11.8. That's at least 3 of those 0.5% differences. So that should make you a whole lot more money. Or there's just having the small value and the large value. That's 12.3. Another 0.5%, or split between the small cap value and the S&P 500. And we show you year by year performance. We show you risk, all the things that if you were a serious do-it-yourself investor. By the way, I really want you to be a do-it-yourself investor. And I will tell you why. I retired from a company. We sold the company. And what we did is we did it for others. That's what we did. And why did we do it for others? Because they have the same problem I have around money that I have, or they have around money that I have around eating. I cannot maintain a discipline to keep my body at the size it's supposed to be. And I live on pills and stents and all sorts of things because I have no discipline around eating. I'm already thinking about dinner. But a lot of people are the same way around money. It is really an emotional topic. They really, if they're losing money, they get grumpy. Even though they're investing for 40 years from now. The market's down and they're grumpy. Grumpy about what? That'd be like if you were in a house and the house price went down, you get grumpy. No, because you're in the house for a long time, theoretically. But people do get grumpy or worried or sick about these kind of money issues. So there are reasons why you might not. By the way, notice the losses. Worst year loss, 43%, 61%, 48%, 55%. Yeah, it's more risky when you buy these things individually. But notice when you put all four together, it's more than 43.3, but it's not as high as 61. It's 51.8. It's diversification. By the way, I'm talking fast and I'm talking loud, but I should have asked once or twice. Anybody have a question about these numbers? Let me ask another question. Are they believable from what you know about investing? I guess that's, this is one of the problems. Who to believe? These numbers are these numbers come from the work of Dr. Fama and Dr. French out of the University of Chicago. Dr. Fama is a Nobel Prize winner. He could be a fake because anybody, it turns out, can be. I want you to add some small cap to your portfolio. It makes sense to me. I want you to have some large cap value in your portfolio because it has historically made more. The same thing with small cap value. I would like you to have maybe all four of them, or like for my granddaughter, two of them. Because in two of them, you capture four major asset classes. With the S&P 500 and small cap value, you capture large cap growth, large cap value, small cap, and small cap value. With two funds. Oh, I didn't finish my story. Why I want you to do it yourself. People who hired me trusted that I was going to work in their best interest, and I did. I always did. And so they paid us 1% to manage their money. Does that number remind you of 9 versus 8? Huh? 6 versus 7? Well, I hope it does. Because to the extent that you will take the time to learn the basics of investing and you keep that 1% and you never have to hire somebody to do it for you, you have just potentially added $3 million to your lifetime saving and investing. And that's not a sales pitch because I have nothing to sell. It's about you and the decisions you make. And you say, well, I can't possibly do that. That's too complex. It isn't complex. What's complex is that when you do it yourself and it starts to go down, you say, oh my God, I don't know what to do. and it went down again today. That's the fourth day in a row it's gone down. It could keep on going down, and I'm ruined. On the other hand, if you have a manager, they'll take care of it. They'll take care of what? Nothing. Because they can't stop it from going down any more than you can. And if you are a buy and holder, and they have recommended buy and hold, and almost every professional I know recommends buy and hold, then what they're really saying is, look, this is, at the end of the day, this is your problem. It's your money. I will sit here and watch it for you, but I can't change what's happening to it. What I can do is I can, in essence, slap your hand every time you try to do something to it and keep you from bailing out. And that's what they're paid for, to keep you from bailing out. So if you can keep you from bailing out, you keep the 1%. I mean, that's pretty obvious, isn't it? You don't have to be smart to teach what I teach. And I mean that. Market timing, there it is. $1 million decision, easy. And I'll tell you why it is. I've talked to people who got out in 2008. You may have forgotten 2008 in terms of the stock market, but I can tell you it was a bad year. A lot of people bailed out, particularly in the spring of 2009. They went to cash. Why did they go to cash? Because their portfolio was down 40%. And they didn't want to lose any more money. Somebody had suggested the market goes up, but obviously it doesn't go up, it goes down. And so they got out. And I know people today who are still waiting to get back in. One bad market timing move can literally cost you half of your retirement. And yet it feels so lonely when your money is there and it's going down, and your heart, you know that it could go down further, because if you ask that professional, and I'm guilty of this too, if you ask that professional, what should I do? They will say, you should be patient because it has always gone back up. And then if you said, can you guarantee me that? And they said anything but no, then they're just salespeople. And by the way, most of the industry is made up of just salespeople. I have friends who were doctors and attorneys and architects and all sorts of things that in order to become licensed to do what they do, they had to study it and take tests that sometimes they had to take the test 2 or 3 times. It takes about 30 days of study to get a license to be able to sell securities to people. So it's more about selling than it is about knowing, because they can't know. And the question is, what makes a great salesperson? People who are overly optimistic. That's what the textbooks say. The most optimistic people make great parents, they make great friends, they make profitable salespeople. But they can be very dangerous for their client because they're so optimistic. That's why when you come to our website, I will introduce you to the downside of every strategy that I recommend, because the downside is just as important as the upside. I don't want you to be jumping in and out of the market. Dollar cost averaging. Now this one is a little more difficult to say that it is a $1 million decision. But here's how it works. I have money to invest, like in my 401k. When should I invest it? And the way that most people do it is it comes out of every paycheck, let's say $100. And so that $100 buys stock, mutual funds, let's say. And when the market is up, you'll buy fewer shares if you have $100 than if the market is down. When the market is down, you buy more shares. When it's up, you buy fewer shares. That's the way it should be done. You don't want to buy fewer shares when it's down and more shares when it's up, but that's what investors do. During big bull markets, when the market's been screaming upwards, people get out their checkbooks. They're afraid of missing. What is that about? Fear of missing out, FOMO, fear of missing out, okay? And so they think they're going to miss an opportunity to make money. Their neighbor's been making money. So it's easy to write those checks when the market's up. It is really hard when the market is down because it feels like the market's going to go down forever. And when I say it can't fail, it can fail with individual stocks. And let me tell you the reality of investing, and you'll never get around this, ever. You invest for 40 years. The market does as you expect. It has some up times and some down times. And at the end of 40 years, it's time for retirement. Now, one of the reasons you don't want to have all your money likely in equities, in stocks when you retire, we don't have all of our money in stocks. We're half in stocks and half in bonds. But we're old, and we don't want to take the risk of losing half of our money again. We've done it plenty of times before, but at this point, we're coasting home. And the reason we have stocks in the portfolio is so that I can leave money to Western, and so I can leave a couple bucks to my kids. It's not for us to survive on, and you are going to find, if you're a decent investor, if you get started relatively early, you do the prudent things, you stay the course, you keep your job. I mean, all those are big things to do. The market will, at least historically, take care of you, but it doesn't stop the market from going down 50% at the end of the 40 years. That's the random thing that we can't, that's why I'm going to introduce you to a mutual fund here in a second that will take care of that for you. Taxes, Roth IRAs, tax-free. Put your money in there, tax-free for the rest of your life. Grows tax-free. Take distributions tax-free. Leave it to your kids tax-free. It is an amazing thing. I didn't have that available to me when I was your age. I didn't have an IRA available to me when I was your age. I didn't have index funds available to me when I was your age. Investing and where you invest tax-wise has never, ever been as efficient as it is right now. Massive diversification. We didn't have massive diversification. Remember, we were told that 15 to 20 stocks was plenty. High commissions to get in. All active management. Now, people had a pension back in those days, not everybody, but a lot of people, and very few people have the pension anymore. You are the pension. You need your money to be managed as if you have your own pension account. And I'll show you how. So, I want you to be in low or no taxation. Now, some people will say, because you have a choice when you're with your 401k, when you go to work, you can probably put in a Roth 401k where you won't get any deduction for your investment, but it compounds tax-free and you get distributions tax-free. If you buy a traditional 401k or a traditional IRA, you get an immediate tax refund, which you go out and have a party with. I say, skip the party. Just put your money into the Roth, because it will protect you against a risk that you can't know. When I was your age, the highest marginal tax bracket was 90%. And the next year it was 70%. Now it's what, 35% or some such number? I don't even remember what it is now. But you don't know what kind of tax you're going to have in your future. So having that Roth IRA means in a way that you invest more because you don't get the immediate refund, but the payoffs are potentially huge. This is, well, in fact, let me ask a question. You have a choice, and it's a legitimate choice. You can do what I have suggested and do it yourself, or you can have somebody else do it for you for the rest of your life, and you will only have to make one decision, literally. How many would still rather do it? Now, you're not going to pay any more. You're not going to pay anybody 1% to do this. I just want to assure you that. And you are going to be in index funds, and you are going to be able to put it into a Roth IRA or a Roth 401k, but you aren't going to ever have to do, and you're not going to have to worry about when to rebalance your portfolio or when should I add some bonds to my portfolio. How many would choose something like that, almost like a pension fund? It is as close to a pension fund as I could possibly come. Managed by the same kind of people, in essence, who manage pension funds. How many would still choose, if you could do it that way, how many would choose to do it yourself? Okay, all right. How many would rather have it just done for you? It's not going to cost you anything, and you're going to get the diversification. Okay. Now that is really an amazing response. I've never asked the question exactly that way. I am curious to hear briefly, shout it out. Why do you want to do it if you can get the same thing without any muss or fuss or work? Yes. Did you hear that? Bonds slow me down, and some of those mutual funds that act like that do that management for me, some of them have bonds in the portfolio when you're very young, but not all of them. That's the good news. That's right. That is a problem with these. By the way, we're talking target date funds. Target date fund, if you want to retire in 2065, you can buy a target date fund that knows you want to retire in 2065 and is going to invest the money almost all in equities from the first time of the first days. That is a change coming in the industry. The industry is starting to realize that mistake, and they're fixing it, just to mention it, because that's recent. And so that's what the target date fund does. It manages much like a pension trustee would manage it for you, and it is conservative. I'm going to show you how to make it less conservative and make more money with one simple step, just one very simple step. But this is what the target date fund is all about. It combines mutual funds, index funds, and it does this management and moves from equities. So, for example, at my age, it would have me probably 40% in equities and 60% in bonds. Another target date fund might have me 30% in equities and 70% in bonds. But I want to be 50-50. So I don't have a target date fund. I want to be more aggressive. We've already talked about index funds. Everything about index funds. Yes, please. Let me make sure I understand. Did you say when you push it back, if you wanted to retire early, ask me one more time. $2065, let's say. Okay. No, it will not be related to Social Security. But you can always change to the 2075 if you wanted to. You always have the ability to change the date of your expected retirement. And then they will continue to manage through death. And that doesn't mean, by the way, that somebody else in the room here wouldn't have a different idea of what that balance of those different asset classes should be, because they think they know better. Now, I mean that in a nice way, but they may not, because nobody knows what's going to be the right decision. I will tell you this. I'm going to show you target date funds. Again, I think I've told you all of this. They take care of everything. This is what they look like graphically. This shows, here's the comment about, see, this company here, Vanguard, has, that's money, that's bonds. See how the bonds are at 10% until you're probably age 40. And then the bonds start going up. Here's another one, BlackRock. They have no bonds in the early years. So you can pick a target date fund that has no bonds in the early years. What I want to point here to, and then I want to leave some time for questions. I want to point to this little study right here. It was done by Wharton, and it was a Wharton Pension Research Project. They looked at 1.2 million accounts at Vanguard, 401k plans. They looked at the people that didn't have any target date funds in their portfolio. They looked at people that had only target date funds in their portfolio. And this is what they found out. And I think this is really important. The expected rate of return of the people who didn't use target date funds was 2.3% less. The people who were doing it the easiest way were getting the best returns. Why? Because the people who were doing it themselves were making decisions like what we would call market timing. They would go to cash when they were uncomfortable. They would go into the stock market when they were comfortable. And they thought because they were comfortable, the market should do what they want. And they felt comfortable enough to believe that. We all know that isn't true when we stop and think about it. We can't know what it's going to do. So that study says to me, if I'm looking for an extra 2.3%, I quit trying to do it myself and let somebody else do it if there isn't some reward, extra reward for doing that. Here's what's wrong with target date funds. They don't have any small cap value, and they don't have much large cap value. So I'm going to suggest one very easy thing to do. By the way, they don't have, in almost all cases, they have almost no small companies. I'm going to have you I'm going to look at Vanguard Fund. That's one of those two that we saw. Historically, if you put away $10,000 a year and added inflation for what you put in, you ended up with about $8 million over a 40-year period. If you just added 10% small cap value, 9 cents in the target date fund, 1 cent into the small cap value. Now, there is a book written about this. The book is free. I'm going to go beyond it here for a second. You already know about this free book. It's called Two Funds for Life, written by Chris Pedersen, a volunteer. He puts in over 200 hours a year working for our foundation. It is a way to combine the target date fund with small cap value. And if we go back, whoops. Cheesy smile. 20% would have taken it up to 12.7 million. It's a way to add the juice, to add some of that you don't have any in the portfolio to give you that kick. And you're young enough. Oh my God, you're young enough to take advantage of that. All right. Oh, this is the boot camp. A lot of this stuff we covered, stocks versus bonds. This is looking at 10 different equity asset classes. This is putting the portfolios together. This is adding bonds. This is, oh, I love it. If you did nothing more but look at the fixed contributions, you would see what would happen if you put away $1,000 a year and you added 3% a year and you put it in the strategies that I'm showing since 1970. Again, you could never buy the past. And oh, I also recommend, highly recommend, recently, Chris Pedersen did a Two Funds for Life video. So go to Paul Merriman's channel on YouTube and look for Chris Pedersen's piece on Two Funds for Life. This is a PDF that you'll get, not hard copy. He's an engineer and I'm not, and when you read our books, you'll see the difference. We have 3 directors. This is another one of our directors. Paul wrote a book, Spending Your Way to Wealth. If you didn't read the book, that's okay, but I want you to read the last 16 pages. Because Daniel Kahneman's book, Thinking Slow and Thinking Fast, is about the biases that we have in decision making. There are 48 biases that get in our way of being a successful decision maker. Kahneman's book is 500 pages long. This syllabus, or this 16-page piece, goes through all 48 of them. And then the book talks about how you try to deal with those biases, emotional biases as an investor. I don't personally handle the emotional side. That's up to you. But Paul does a good job, I think, of trying to help people through that. Now I want to take questions. And email me, paul@paulmerriman.com, if you have questions. And we have 10 minutes for questions. I think I've got those questions. Anybody got a question? Huh? Everybody wants to just go home? No, you can be honest with me. That's what I told my kids when they left. BlackRock is, yes, BlackRock is one, and T. Rowe Price is another. Pardon? Can you repeat the question? Oh, I'm sorry. Yes, the question is BlackRock the one that is one that does not have any bonds in the question was, is BlackRock the one that doesn't have any bonds in the beginning? Yes.
Stocks that pay dividends.
What about what?
Stocks that pay dividends.
Stocks that pay dividends. Stocks that pay dividends don't make as much as the market itself. What about stocks that pay dividends? And the dividends make people feel good, but they're actually, that's the only thing that they do. Because you could, instead of you taking the dividends, you could just sell shares in the same amount and you would in theory be in the same place. Okay? But people like dividends because it makes them feel like that's their income. Warren Buffett never paid a dividend. Warren Buffett just kept, because he always felt he could manage the money better in the business, and people got rich. And
What if you were to put it back in and kind of recycle it through?
it will, basically dividend companies are like value companies. And so they are going to pay a decent return. They are not growth companies typically, but they're fine. The answer is, if somebody buys a target date fund and it works for life, great. Because the best strategy is the one that people will stick with. And people who get dividends for their stocks, and there are mutual funds that all the stocks inside the mutual fund. Vanguard has very fine dividend stock fund, but they're very conservative. Yes.
What about, you talk about on your website or maybe your book about
socially responsible or ethical mutual funds?
Socially responsible funds, ESG funds are great. And these kinds of funds have been, historically, their performance has lagged. And by the way, that means that the companies inside the mutual fund are they were originally called socially responsible. And now they specifically talk about environment and social and government governance. And so if a person is willing to buy and hold a socially responsible fund, Vanguard has a terrific one, then I think they're going to stay the course. Because if you can't stay the course, whatever it takes to get you to stay the course. Back to the paying somebody 1%, so you'll stay the course. But I would rather have you stay the course because of the kind of a mutual fund that you own, and it's the kind of mutual fund you should own for a lifetime. My wife and I are only half in equities. But half of that equities is in small cap, and half of that small cap is value. We have a lot of small cap value in our portfolio. It's not just for kids. Thank you. Thank you all. By the way, did we pass around and get the email address so we can? Now, we're not going to email you if we didn't win anything, okay? What we could do is we could somehow post the numbers so that people could double check as an audit, okay? Yes.
So I am someone who is familiar with Vanguard. So what would you recommend? How would you recommend to purchase stocks that are a little bit less conservative, like the mutual funds?
With a mutual fund, we have on our website recommendations at Vanguard and at Fidelity and at Schwab. But we also have what are called best-in-class ETF recommendations. The best-in-class ETFs can be purchased at Vanguard without a commission, okay? And the same at Fidelity. Now, Fidelity is a little better because Fidelity allows the partial share purchase that Vanguard doesn't. And so it's a little easier at Fidelity, but Fidelity is also commission-free. And I mentioned up here Chris Pedersen's 2 Funds for Life. The other video he does on selecting best-in-class ETFs. He's one of the best teachers I've ever seen. And I think he'll make it very clear what he does to help you be in the very best of the different asset classes, whether it's small cap value, large cap value, international small cap value, emerging markets, all of the different major equity asset classes. This can all be very complex if you want to make it complex. My goal is to keep it simple. And probably the 2 fund strategy is going to give you enough juice on the upside. In fact, I'll even share with you why for my granddaughter, I wanted to have a combination of the S&P 500 and small cap value. I truly believe that the best thing for her would be to have that money in small cap value. But when she's 18 years old and she opens up the video from me and reads the letter from her grandmother and her grandfather, she is going to know that she has had these 2 different asset classes, one very high quality, one less high quality. And that for her to notice the difference in return each year. And how for some years, small cap value was better. In other years, the S&P 500. And to know that the S&P 500 may have made less, but it was less risky. And if over the next 50 years, she gets a return that's even close to what she got for the first 18, because she'll see it. And by the way, it could be bad. And that'll make me sad. But I'll be dead. So I'm saving a lot of that for later. But there's hopefully a teaching moment for her, because the big problem with trying to do things for kids is that you don't know what the kids are going to do, what they're going to want to spend that money on. You talk about that $365 a year for 65 years. Well, by the time it's worth maybe 4,000 or 5,000, maybe 10,000, maybe, where is it that all of a sudden it looks like something more exciting than waiting around till you're 65 and start living off it? It's not easy to have delayed gratification. It really is, it is the key to the success of an investor, is the willingness to delay gratification. I worked longer than I had to for money. I haven't worked for money for, 11 or 12 years now, but I worked longer than I had to because I wanted to oversave. This is a decision each and every one of you are going to make. You're going to make it by design, or you're going to make it by default. But if you retire at 60 with just enough, you might, and we talk about this when you get into the distributions part of our work that we write and do podcasts and videos about. But you're going to have to make a decision. Is it time to quit working and start enjoying life? Because who knows how long I'm going to live is what people will think. I want to enjoy life. I haven't enjoyed my job that much. Well, I loved my job. And so for me to work 5 more years and accumulate the extra money from the 5 more years meant that not only did I have fewer years the money had to underwrite my retirement, but I could take out more. We could live bigger, and we have lived bigger because I worked a few more years. And you will make that decision. Now, you may not think of it that way when you make it, but a couple more years of work can do a lot, I think, to build the portfolio. And the last thing you want to think about now is working more years, because you, in many cases, it's not even started. Thank you for your patience. You don't mind if we let you out of class early today?
Western, thank you all for attending here and online, and
Yes.
thank you, Paul, for sharing your.
Thank you. Thank you. Good luck. Good luck. Thank you.
Also, thank Paul for helping us establish a program to improve financial literacy here on campus and the broader community. There are resources already available there, so please take use of those. And please look at our website. We will also post our resources that all of the
Okay.
Yeah.
Thanks, guys.